Greetings and welcome to CCIM Institute's webinar, Your Voice on the Hill, Commercial Real Estate Public Policy, featuring NAR's Director of Federal Housing and Commercial Policy, Megan Booth, and its Senior Policy Representative for Commercial Issues, Aaron Stackley. Megan's purview includes federal housing programs such as FHA mortgage insurance, VA loans, and rural housing programs, as well as multifamily and property management issues. Prior to joining NAR, Megan worked for Bovis Construction Management, American Maritime Officers, and on Capitol Hill as a legislative aide. Megan received her BA from the George Washington University and a master's degree from George Mason University. Aaron provides legislative and regulatory analysis and advocacy on commercial real estate issues, including banking and financial regulations, fintech, unmanned aerial systems, small business insurance, and commercial, environmental, and tax issues. She received her JD from the George Mason University School of Law in 2011 and has experience working on Capitol Hill, both for a personal office and a committee and in executive agencies. During today's webinar, you will have the opportunity to ask questions by using the Q&A feature located in the toolbar at the bottom of your screen. To ensure enough time is allotted to cover today's content, the panelists will respond to questions at the end of the presentation. Additionally, if you're experiencing any technical difficulties, please use the chat feature. A recording of today's presentation will be made available to attendees within the next 24 to 48 hours. And Megan and Aaron, please continue with today's presentation, and thank you.
Great, thank you, Liz. This is Aaron, and I'm going to start us right off with the first issue that we'll be covering, the National Flood Insurance Program reauthorization. So if any of you have been following this program for longer than about 3 months, you know that it's Congress's favorite thing to kick this issue down the road by a few weeks sometimes, a few months, etc. So most recently, we had a short-term extension that reauthorized the program through September 30th, 2019. Earlier this month, we also had something a bit more substantive come out of the House Financial Services Committee, which approved HR 3167, a 5-year reauthorization bill. This is a bipartisan package. As I mentioned, it reauthorizes the National Flood Insurance Program for 5 years. In addition to that, it makes some improvements and reforms. It has some changes to the mapping provisions, which is one of the things that NAR has been advocating for a long time, to modernize and improve the flood mapping system that that FEMA uses, as well as reforms to the mitigation provisions. And it also provides clarification that properties that have private flood insurance can still satisfy the NFIP's continuous coverage requirement to qualify for the program. The NFIP is often thought of as more of a residential issue than a commercial issue, but if you are a property in a flood zone, then you have to have NFIP coverage. It does not distinguish between residential and commercial, just like those floodwaters don't. So NAR is pushing very strongly to get this long-term reauthorization through Congress before the September 30th deadline. This movement through Financial Services Committee is a positive first step. It does still have to be passed by the House, and then the Senate will have to take up a bill as well. So we do expect to see some alterations to the language, but we are hopeful that this will get through before the 30th of September. Next up, I'm going to talk about tax extenders and specifically the 179D reauthorization. So 179D is the energy efficient commercial buildings deduction. It provides a deduction of up to $1.80 per square foot in the year of an upgrade to a building's energy efficiency. This is worked around the building envelope, HVAC systems, etc. And it doesn't prescribe how to make these improvements, just that they have to be certified by a third party, and then you can apply for the deduction. It was last reauthorized by the February 2018 budget deal. But the reauthorization was retroactive through 2017, so it only applies to upgrades made in that year. So it can be claimed in 2018 for 2017 upgrades. That sort of retroactive reauthorization is how Congress has handled a lot of these extenders recently, where they are allowed to expire and then later the following year, or sometimes more than a year afterwards, they retroactively reauthorize it through the end of the previous year. Obviously, this impacts the usefulness of things like this, because if people are making decisions about whether or not to make energy efficient upgrades to their buildings and they don't know if this deduction is going to be reauthorized because it has been allowed to expire, then they might opt against making those improvements because of the uncertainty attached to it. So where are we now? There was, in June, earlier this month, we had some activity in the House Ways and Means. They marked up HR 3301, which extended the sort of orphan tax provisions, as we call them, including 179D through 2020. Before that, Senator Grassley from Iowa, who is chair of the Senate Finance Committee, tried to get some movement on an extenders package, but there was actually some issues with the House Ways and Means Committee, stemming from the fact that many of the members are new and they don't really understand extenders, plus issues with not offsetting the lost revenue and extension of the provisions would create. So on the Senate side, Senator Grassley and ranking member of the Senate Finance Committee, Senator Wyden from Oregon, formed a bipartisan task force to study what should be done with these expired provisions. So the movement in the House Ways and Means Committee is positive with this 3-year extension. That would be 3 years retroactive to 2018. However, the bill that they passed is not offset. So there's not in it a way to pay for the change in revenue that giving these tax provisions back would create. So many Democrats will want to find a way to pay for it before they'll support it. That would likely come in the form of rolling back some of the tax cuts that were in the Tax Cuts and Jobs Act of 2017, which would then alienate Republicans. So it's a bit of a tricky situation. What's interesting is that 179D on its own has bipartisan support and would likely be reauthorized as a standalone extender. But right now, they're treating all the extenders on this package basis. And so it's actually more threatened as a result of being grouped with the other extenders, because altogether, they create a lot more loss of revenue for the federal government. So next steps are unclear, but we are happy to see that both the House and the Senate are looking at this issue and taking some actions on it. Next up, infrastructure, everyone's favorite hot topic. So everyone agrees that we need an infrastructure bill and that it will be expensive. The American Society of Civil Engineers grades the current state of the U.S. infrastructure at a D+, which is actually a higher grade than we've received in other years. So I guess that's a good trend, but it's still not a passing grade. The controversy is mainly about how to pay for infrastructure. Democrats support a spending bill. There's some talk of creating tax incentives, and then, of course, lots of discussion of public-private partnerships with incentives for private groups to invest in infrastructure in the country. There's also the issue of how we define infrastructure. For some communities, it's as simple as improvements to roads and bridges. For others, they want to make their city more walkable or have better public transit available. Getting broadband to rural communities is considered infrastructure. And finally, there's the issue of how we look ahead. If we're going to invest a lot of money in infrastructure, obviously we need to improve the existing infrastructure, but we don't want to get to a position where we've invested a ton of money only to have a lot of it obsolete within a few years. So we should be considering future needs, like highway lanes for driverless cars, for example. So earlier this spring, we had a positive step on this issue. Democrat leaders and the president came together to an agreement on the cost for infrastructure, which was $2 trillion. These talks, however, fell apart in May due to an unrelated disagreement over border issues, and they haven't really picked up again since then. However, the House, it is still possible that the House will advance an infrastructure bill even without White House support from the House Transportation Committee. The prospects of something like that passing into law are pretty slim, especially with a $2 trillion price tag, but this is something that can only be ignored for so long, and as the current infrastructure we have continues to sort of degrade, and as the needs for new types of infrastructure increase, it's going to be something that the administration and Congress will have to address. Next up, we have opportunity zones, which is a hot topic at the moment, especially among commercial real estate. So I'm going to first talk about where we are on opportunity zones rulemaking, and then I'm going to do a real quick primer on what this program is for any of you who are not familiar. Hopefully you have at least heard of this program at this point. And I'm sure some of you are involved in working with properties that are in zones, perhaps working with some of the funds. So opportunity zones are a program that were created by the Tax Cuts and Jobs Act. And there are tax incentives for investing within these designated low-income communities. There have been two sets of rules that have come out for how this program will run. The first was last October, and the second round came out in April. These proposed rules are not final, but they are effective, which allows for funds and investors to begin utilizing the program, which is important because there are some deadlines that are built into it. The rules that we had in October sort of provided a broad sketch of what this program will look like. And then the rules that came out in April were much more detailed with sort of better instructions and guidelines for funds as to how they can invest in opportunity zones, and also what type of properties qualify as qualified opportunity zone business property for them to invest and reap the benefits of the program. Again, these rules are not final, but they are effective. So some of the deadlines that we have, final rules are expected by the end of 2019. However, in order to get the full complement of benefits for the opportunity zones, the deadline for people to reinvest capital gains into an opportunity fund is also the end of 2019. There is a possibility that there will be legislation to extend that deadline by a year or two to give people more time to engage in it. However, that is, again, something where it would technically cost the government money, and so they'd have to figure out a way to offset those costs. So if you or a client are considering working with the Opportunity Zone program, I would encourage you to try to get all of that in by the end of this year in order to get the full tax benefits. Now, there's still benefits available even if you miss the end of 2019 deadline, but to get the full complement, end of 2019 currently is the deadline. So we have heard that Treasury and HUD are also putting together proposals for the data collection requirements, although there's now some discussion that perhaps Treasury won't be releasing another set of rules on data collection. Data reporting is going to be an important aspect of this program because it'll allow us to track how much people are investing, where the investments are going. We expect commercial real estate to be very hot in the first sort of rush for these investments, but people can continue to invest in opportunity zones through 2028. So, what's going to come after the commercial real estate rush? We also need to be able to see, is this program actually benefiting the communities that it's in? Is it creating jobs? Is it creating businesses there? improvements to property values? And also, is it doing so in a way that is sort of thoughtful? One of the main criticisms that has been thrown against the program is that it could lead to gentrification and negatively impact the people that live in those communities now. So one of the ways to track whether or not that's happening is data reporting requirements from investors. So while we're not really sure what sort of requirements the federal agencies will put out, if any, Senators Booker from New Jersey and Tim Scott from South Carolina, who were the original co-sponsors of the original Opportunity Zone legislation in the last Congress, have introduced legislation that would impose some of those data reporting requirements. So I'm going to go over some of the basic outlines of the program now. There's several tax benefits for investing in opportunity zones, and the way that I like to talk about it is through two phases. So the first phase deals with reinvested capital gains. So someone comes into some capital gains and they have 6 months or 180 days, so keep track of how many days are in those months, to reinvest those gains into an opportunity fund. While they are in the fund, there is a deferral of paying the capital gains tax on those reinvested capital gains until whichever comes last, pulling those gains out of the fund or December 31st, 2026. So your first tax benefit is being able to defer paying tax on those gains, potentially through as late as 2026. Then the second benefit in this first phase is that if you hold those reinvested capital gains in an opportunity fund for 5 years, you get a 10% reduction in the capital gains tax that you ultimately pay on them. If you hold for 7 years, that increases to a 15% reduction. So that's where we run into that December 31st, 2019 deadline to get the full complement of tax benefits. Because in order to have held them in the fund for 7 years by the end of 2026, the capital gains will need to have been reinvested in the funds by the end of 2019. So the second phase of these tax benefits is tax-free appreciation. Once you invest these capital gains into an opportunity fund, the clock starts ticking. And if you hold them in that opportunity fund for 10 years or more, any new appreciation on those gains while in the fund are tax-free. So you have until the end of 2028 to reinvest capital gains into an opportunity fund, and then they can be held until the end of 2047, and any appreciation is tax-free. Now, obviously, if you invest after 2021, then you won't get any of those reductions in the capital gains tax paid on that initial reinvested amount. But there's obviously still benefits to be had on that tax-free appreciation, especially if this program works the way that it does and increases property values, brings jobs, business, and growth to those areas where the opportunity zones are. If you have questions about opportunity zones, it is a pretty complicated topic. So I would encourage you to check out NAR's page that we have on it, and also to seek out information from your state. Some states are offering sort of additional incentives and benefits for investing within their opportunity zones. Many states have set up websites devoted specifically to their opportunity zones within their borders, and a lot of the state and local economic development groups are also very active on them. So the opportunity zones are designated by census tract. They were nominated by the governors in 2018 and finalized and approved by the IRS and the Treasury. The zones that currently exist are set in stone. They are not currently contemplating authorizing new areas or designating, undesignating some and designating others instead. So the zones that are currently there are the ones that we expect to be there until the end, and you can find a lot of maps, especially broken down by state, if you look at your state websites. So the last issue that I'm going to cover is cannabis banking and safe harbors, which is sort of a new-ish issue for NAR. Our policy on this was created at the May meeting in DC that we had this year. So 33 states have legalized cannabis for medicinal uses, and 10 states and DC have legalized it for recreational use, which means that most of you probably are calling from or listening to this webinar from a location where it is legal in some capacity to use cannabis or marijuana. This has become huge business. In 2018, they estimate that about $10 billion was invested into cannabis businesses in the US alone. And it also holds a lot of potential for commercial real estate. These businesses need places to grow their products, warehouses to store them in, and storefronts, etc. The issue, however, is that cannabis is still a federally controlled substance, so it is still illegal technically nationally. This means that FDIC-insured banking institutions cannot work with cannabis businesses. So while you may have some smaller state and regional banks that do not have FDIC insurance, most financial institutions technically risk running into the law if they work with cannabis businesses. It also means that third parties who work with and accept payments from cannabis businesses could be held liable under anti-money laundering laws, which includes real estate professionals, property managers, etc. The result of these sort of conflicting state and federal regimes is that in many areas, cannabis is an all-cash business. And as I mentioned, it is big business, which means that they are holding on to a lot of cash reserves, which creates a safety issue for the communities that they're in as they become targets for crime. It also hinders their growth. When you can't access a traditional bank or financial institution, then it's a lot harder to walk in with a backpack full of money and buy property. So we have seen some bills introduced this Congress. There's two, the Safe Banking Act and the States Act. They're bipartisan, and these would create safe harbors for banks and businesses in states that have legalized cannabis from federal prosecution. So as long as you are a duly registered business in a state that has legalized cannabis for whichever purposes you yourself are engaging with the product, you would be able to access that bank. And the realtor that you work with or your property manager would not be risking running afoul of the law by accepting payments from you for the services that they provide. We do expect to see some movement on these bills this summer. Cannabis is a weird issue. People like the fact that it is bringing money in, but then you have people that are very opposed to it on, for example, moral grounds, and so it really creates some interesting divides on Capitol Hill. So we are going to be advocating in support of these bills because we have policy now that says if it's legal in the state, then they should be able to access banks because that's just better for the economy, better for the businesses, and obviously better for commercial real estate. So with that, I'm going to turn it over to Megan.
So I'm going to talk a little bit about a technology issue related to the FCC, the Federal Communications Commission. So probably about 10 or 12 years ago, we were engaged in discussions with the FCC on what they call the Over-the-Air Reception Device Rule, or OTARD. And at that time, the OTARD rule mostly applied to where could telecommunications companies place satellite dishes and other equipment like that on private property, and if it's leased property, where could tenants place those devices. So like I said, back then it was satellite dishes, so there were lots of rules, and we went back and forth with the FCC over where, for example, a tenant in a multifamily building could put a satellite dish. We were very opposed to just sort of willy-nilly letting people put satellite dishes on their balconies, for example, because if that satellite dish comes flying off and smacks a pedestrian on the street below, who are they going to sue? They're going to sue the building owner. They're not going to, they might eventually sue the tenant when they figure out which unit it came off of, but they're going to figure the big pockets are with the property owner, so they're going to sue the property owner. We also had aesthetic concerns with you had buildings that were covered in the whole front by satellite dishes. That's not very attractive. And then there were issues of safety and space on the roof. So if you were a telecommunications provider and you wanted to place equipment on a roof, we wanted to make sure that the building owners had an equal chance to negotiate with those telecom providers for usage of that space. Now the big issue is with the expansion of 5G, which is something we certainly support. We all need technology in our lives and good, reliable telecommunications providers. But with the FCC and its effort to sort of speed up the development of 5G and the deployment of the 5G towers, is they've decided to use the old OTARD rule to say that that the 5G should be treated just like the OTARD rule. And then they go even a little bit further, and they sort of are limiting the ability of property owners to control what and where wireless infrastructure can go on the property. So again, this is an issue that will both impact leased property and the tenants in that property, and any other private property where if you already have a contract, basically what the FCC rule sort of indicates is that if you already have a contract with a telecommunications provider to put equipment on your roof, that you would not be able to renegotiate that they could use that existing contract to put up 5G transmitters where they might have other equipment now. Where we think you should be able to renegotiate the contract if they're changing the equipment that they're putting on your property. And in the lease space and lease buildings, you want to make sure that tenants are not just placing these 5G receptacles all over the property. Just for a little background, the difference between 4G and 5G or 3G and 5G is, if you look at the picture on the right, the 3G and 4G towers, you need really huge towers with tons and tons of space on them to transmit the signal. 5G is a little bit different in that instead of having huge towers that transmit the data, they're going to have lots of tiny towers everywhere. And so you can imagine a leased apartment building, say, that has a whole bunch of these little towers like the one on the left on everybody's balcony. And those residents may be compensated for putting a transmitter / receiver on their property, but really that's not their property, that's the property owner's property, and so they should have more ability to negotiate how those transmitters and receivers are placed on their property. So we have joined in with a coalition, the same coalition we were with under the satellite dish rules, and so it's groups like BOMA and National Multi-Housing Council and NAREIT and all of the big real estate groups around town. Joined into coalition to submit formal comments to the FCC opposing this move in the new OTARD rule to just use the old OTARD standards and not allow anybody to renegotiate contracts or sort of have more control over their property than they could under this deployment. So it's going to be a long process. The way the FCC does it is they sort of put out this proposed rule and then they accept comments, and then they put out something, and then you can, or even actually at the same time, you can reply to all the comments that everybody else proposes. So we are currently in the reply comment stage where we see all the comments that the 5G providers have put out, and we can respond to those comments and say why we have a difference of opinion with them. So this will be ongoing. Obviously, like I said, we all support the deployment of 5G, but we still think that you should have private property rights with respect to that. So that's sort of a new issue we haven't been dealing with in a while, but it's back, and so we will be continuing to follow it. So I think that's all we have for our issues. I don't know if anybody has questions on anything that we have just covered.
This is Liz. We've got a few questions for Megan and Aaron. The first question is on opportunity zones. The question is, I've come across several smaller cities and communities that would easily qualify as opportunity zones. However, they did not get the materials in time to receive the qualification. I've heard rumors that there will be a chance for new communities to step up and qualify for to be qualified as an opportunity zone, but that there's not a high priority for that. What have you heard regarding new cities and community applications and inclusions? And if so, what kind of time frame could this happen in? And are we lobbying for newer inclusions?
So what we have heard is that there will not be new opportunity zones added. There was quite a crunch to get, for the governors to get their nominations into the IRS and the Treasury. They basically had about 6 months from the Tax Cuts and Jobs Act passing to get their nominations in, and the IRS and the Treasury then reviewed them and either approved or denied. There is, I believe, almost 10,000 census tracts that have been nominated or that are designated opportunity zones across the country right now. Unfortunately, every community that qualified would not have made it in because they did have some limitations on how many census tracts could be zoned, how many each state would have, etc. Different states used different processes to come up with their zones. Some states I know wanted to have at least one zone from each county. Many states did a really good job of balancing sort of suburban areas, rural areas, and urban areas across their areas, across their regions, to make sure that the different types of areas were all well represented. But we have heard from some members that they were disappointed in the way that their states went about the nomination process, and that they were disappointed that some areas weren't designated. However, right now, there is no contemplation on the Hill or in the agencies to do another round of zone designations. Of course, it's always possible that as the program sort of gets a little bit more mature, that they would revisit those zones themselves. However, at this point, like I said, they're not contemplating adding or redesignating any areas as zones.
Erin, thank you. The next question we have is about the tax extenders bill. Does the extender bill include the Section 45 capital L credit for eligible multifamily and assisted living dwelling units? To receive this credit, the dwelling unit must meet certain energy efficiency requirements. Yeah, and is this Section 45L credit a part of the current tax extenders bill?
So the bill that passed the House Ways and Means Committee, the one that they marked up and approved, I believe extended all of the expired provisions through 2020. So yes, that should be included in there as well. Again, as I mentioned, you know, there's concerns from Democrats about how they're going to offset all those costs. And if they propose offsetting them through pulling back some of the Tax Cuts and Jobs Act tax cuts themselves, then that would raise issues with the Republicans. So while that bill passing out of committee is positive, its hopes of being enacted into law are probably less than 50%. So on 179D, at least, what we would hope for is a standalone bill to reauthorize that provision. However, at this point, they are considering all of them on a package basis.
Thank you, Erin. We have an additional question on the flood insurance reauthorization bill. I remember there was a reauthorization bill that was passed by the House during the last Congress. Is this reauthorization bill similar in content to that bill from the prior Congress?
Yeah, I believe so. I mean, there's always a little bit, you know, the details get a little bit fudged from one to the other. last Congress, obviously, Republicans had control of the House, and now we're working with Democrats. But this is a bipartisan bill that passed out of the Financial Services Committee. So nothing major, no major differences that jumped out at us between the two.
Thank you, and I'll give it a second. Does anyone have any additional questions for Megan or Aaron? Give it a minute. Okay, I think Megan and Aaron, thank you so much for presenting this webinar today. We appreciate your expertise.
Great time. Yeah, thank you. Our contact info is up on the screen now, so if anyone has any questions that they're too shy to ask or that they maybe can't type in at the moment, please reach out to us.
Okay. Thank you.